Hello and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's go watch the analysis.
Okay. Friday, February 13th, 2026. The closing price, $22.20.
Which is a single-day appreciation of what, 4.82%?
And the volume, let's see, 2,049,929 shares.
All while the broader tech and industrial sectors were, they were bleeding out, down more than 1% across the board.
That number, 2220, that's our anchor. It's a market cap of roughly $2.68 billion. But if you're just looking at the chart, it's a signal. It's a clear signal in all the noise of a pretty chaotic logistics market.
But context is everything here. Pull back to the 52-week range, we're looking at a low of $11.04 and a high of $24.47. We are getting very close to the top of that channel. And let's not forget, just 3 days before, on February 10th, we saw a drop of 2.31%, purely on reputational headlines about MSC. So this volatility, it's not some random thing. It's structural.
And then the catalyst, Sunday, February 15th. The news breaks about the strategic review. And suddenly, we're not talking about freight rates or bunker fuel anymore. We're looking at a definitive acquisition framework, Hapag-Lloyd and Bobio and the FIMI Opportunity Funds, a deal valued at over $3.5 billion.
Right. Which brings us right to the central question, doesn't it? Is this acquisition a validation of a totally misunderstood asset? A masterful way to navigate some very tricky geopolitical constraints and unlock value? Or is it a ceiling? Is it a forced cap on shareholder value that creates an existential risk for the very national security it's supposed to protect?
Well, I'm here to argue this deal is a strategic triumph. It validates their asset-light model and, frankly, protects shareholders from what could be a cyclical abyss.
And I'm here to argue that this deal is a capitulation. It creates a kind of bad bank situation for the domestic fleet. It absolutely caps investor growth potential. And it just ignores the regulatory storm that's about to turn this whole thing into a nightmare.
Okay, let's look at the position clearly. For months, the market has treated ZIM like a distressed asset. It's been trading at this, almost comical discount to its intrinsic value. Now, when I say intrinsic value, I'm talking about the underlying worth of the contracts, the fleet, the cash on hand. Some models put that number as high as $177.90 a share. And yet, here it was, trading in the teens.
Well, intrinsic value is a theoretical number on a spreadsheet. The market price is what someone is actually willing to write a check for.
That's my exact point. The market was wrong, and the board knew it. Remember, they already rejected the management-led buyout at $20. They went on record, said it was significantly undervalued. So what happens now? We get a deal structure that solves the unsolvable problem. You have Hapag-Lloyd, they take the global operations, that solves the scale issue. Then you have FIMI, they take this domestic assets, which satisfies the state of Israel's golden share. The stock holding its base above that 200-day moving average, 1666, that was not an accident. That was the smart money seeing exactly this kind of resolution on the horizon. The deal validates the equity. It bridges that gap between a misunderstood stock price and the reality of the asset.
You're calling it validation. I call it a forced exit. While that premium looks nice today, sure, compared to $22, you are ignoring the structural wreckage this whole thing creates. You have to listen to the warning from Zadok Redker, the director of the Administration of Shipping and Ports. He didn't mince words. He called the separation of high-margin international routes from national operations an existential threat.
Oh, come on. That's just bureaucratic posturing.
Is it? I think it's operational reality. Think about how a shipping network actually functions. You can't run a national fleet on domestic volume alone. It just doesn't work. It needs cross-subsidization. The huge profits from, the Trans-Pacific and Asia-Europe routes are what pay for the less profitable but essential security routes. By stripping those profitable lanes away and giving them to Hapag-Lloyd, you are leaving the new ZIM, the FIMI part, with no caloric intake. It can't survive. And for the shareholder, this effectively delists the company. It deletes the ticker. So the public investor is completely barred from participating in any future recovery or that green re-rating we've been hearing about for years. You're taking a potential 5x return and just swapping it for a quick payout.
Actually dig into this deal structure because that's where the genius is. We have to be pragmatic. ZIM operates under a golden share.
Which is basically a poison pill held by the state.
It's a geopolitical shackle, yes. It requires the company to maintain capacity for national emergencies. In a normal merger, no foreign company like Hapag-Lloyd could just buy ZIM. The state of Israel would veto it instantly. They can't have their national supply line owned by a German or Swiss company. So this bifurcation, splitting the company in two, it's the only way out. Hapag-Lloyd gets the 99 chartered vessels, the global brand. They integrate ZIM into the world's 5th largest carrier network. That is immediate scale. FIMI, which is Israel's largest private equity firm, takes the 16 owned vessels and the headquarters in Haifa. It ensures continuity. It's a surgical separation of commercial ambition from national duty.
Surgical? It looks a lot more like an amputation. And you're just assuming this deal will even close. The Administration of Shipping and Ports is already signaling they're going to fight it. If they block this deal because they're worried about the national fleet collapsing during a conflict, what happens to the stock then? It doesn't stay at 22.20, it falls right back to what the analysts are targeting. We're talking about a reduced rating with a target of what? $15.12. That's the downside risk you were just glossing over.
But every M&A transaction has risks.
This is more than just closing risk. The golden share isn't just a box you check, it is a veto power. And right now, the regulators are looking at a deal that strips out the profit engines, the global routes, and leaves the state holding all the liabilities. If FIMI takes the domestic arm, they are inheriting a cost center, not a profit center. How long before they start asking for state subsidies? This isn't a solution, it's just shuffling bad debt around. And if the state sees that coming, they will kill the deal, and the stock price will collapse right back to $15.
But the market clearly disagrees with your risk assessment. Look at the volume on February 13th, over 2 million shares. The stock was up almost 5% while the whole sector was down. That is the market pricing in a successful close. The market understands that FIMI is not some novice player. They are sophisticated operators. They would not get into a deal they couldn't structure profitably. But let's move on to the financials because I think your skepticism completely ignores the resilience ZIM has shown. You're acting like the company's bleeding out, but the balance sheet tells a very different story.
Resilience. I see gravity taking hold. We have to talk about the 2025 crash. You can't look at that $22 stock price without looking at the earnings cliff it's about to fall off of. In fiscal year 2024, ZIM was printing money. Exceptional profitability. Net income of $2.15 billion. Average freight rates were sitting at $1,888 per TU. That's the 20-foot equivalent unit, the standard cargo measure. But then look at Q3 of 2025.
I'm looking at it. It was a correction? Absolutely.
A correction? It was a bloodletting. Net income dropped 89%, down to $123 million. Freight rates collapsed to $1,602. That's a huge decline. The business resilience you're talking about is it's fading as rates go back to normal. This buyout premium is a mercy kill before the earnings go negative.
That is a profound misreading of the cash flow statement. You're so focused on net income, which, is an accounting metric. It's heavily influenced by things like depreciation. Let's look at the actual cash coming in the door. Even in that disastrous third quarter of 2025, with rates dropping, ZIM generated $628 million in operating cash flow, $574 million in free cash flow.
Cash flow lags earnings. Those contracts were signed when rates were much higher.
But the cash is real. In a down cycle, they printed over $500 million in free cash in a single quarter. That is not a company in distress. That is a cash machine running at lower RPMs. And look at the return to shareholders. They consistently give back 30% of net income. We're expecting a dividend on March 11th of around $3.17 a share. That dividend alone is a massive yield. The company is healthy. The drop in net income is just a return to reality after the pandemic highs. But the floor is much higher than you're admitting.
A dividend in March is a parting gift. It's not a future strategy. It is probably the last check these shareholders will ever cash. If the deal goes through, that dividend is just one part of the liquidation of value. But I want to press you on this. This future you think exists if they stay independent. You say they're healthy, but you're ignoring the macro environment. We are facing a supply-side tsunami.
You mean the global order book?
I mean, the fact that the global fleet is growing by, 3.6 to 5% in 2026, while demand is only growing 1.5 to 3%, the math just doesn't work. The order book, the number of new ships being built, is 26 to 28% of the existing fleet. The market is about to be flooded with steel. And when supply outstrips demand, freight rates crash. It's economics 101. And you want to talk about green logistics saving them? Green doesn't matter if the ships are sailing half empty. Maersk, MSC, CMA CGM, they are all just dumping capacity into the water. ZIM is going to get squeezed.
On the contrary, green is exactly what saves them from that oversupply. This is the strategic pivot that justifies the valuation and, frankly, explains why Hapag-Lloyd wants them. By the end of 2025, 40% of ZIM's operated capacity will be LNG-powered, liquefied natural gas. And this isn't just, eco-posturing. This is hard economics. LNG is 16% cheaper than low-sulfur fuel oil right now. It's a massive hedge against carbon taxes. So while their competitors are paying premiums for dirty fuel or carbon credits, ZIM is running cheaper.
It's a capital expense in a falling market. They're paying premiums for those vessels.
It's a survival mechanism. You mentioned the regulatory storm. Let's talk about the CII, the Carbon Intensity Indicator. This is the IMO's report card for ships. By 2030, only 19.7% of the current global fleet will meet the targets without major upgrades. Think about that. 80% of the world's ships are about to be non-compliant. The rest of the industry is going to be scrambling, slowing down ships, scrapping them. ZIM is already there. They have the LNG fleet. And because of their asset-light model, they charter 95% of their fleet instead of owning it. If demand really drops, they can just return the ships. They can shed the 174,000 TEU of capacity. They have a throttle. Their competitors have an anchor.
That flexibility is a double-edged sword, though. Yes, they can return ships, but they still have to pay for the new LNG charters they've committed to. They just signed on for 10 more 11,500 TEU vessels for delivery in 2027 and 2028. That is a $2.3 billion liability hanging over them. You don't just return those without huge penalties. And about the CII, industry chaos drags everyone down. If Maersk and MSC have to slash the rates to fill their old ships, ZIM can't charge a premium just because they burn cleaner gas. The shippers, Walmart, Target, Amazon, they just want the lowest price to move a box. They're not going to pay ZIM an extra $200 a container to feel good about the environment. And speaking of MSC, that partnership, which you see as an asset, is becoming a liability. That February 10th drop was driven by MSC's reputational risks. ZIM is hitching its wagon to a partner that brings a lot of heat.
The MSC partnership guarantees them an 11% market share on critical Trans-Pacific lanes. It gives them the scale of the world's largest carrier without the capex. It's a brilliant use of leverage. But I want to circle back to the valuation, because this is where we really diverge. The 5x thesis. This is the heart of the bull case that you seem to be dismissing.
The 5x fantasy, you mean?
The math. A five-fold increase implies a stock price of $111, a market cap of $13.4 billion.
Which is 5 times higher than today. It sounds like science fiction.
And yet, it's still below the intrinsic value estimate of $177. Look at the multiples. Under a base case scenario, the stock is technically undervalued by 88%. Here's the logic. ZIM trades at a PE, price-to-earnings ratio, of 2.7. That is dirt cheap. The peer average in the industrial sector is 16.7. If the market simply decided to view ZIM as a green tech logistics company instead of a dirty old shipping company, the multiple expansion alone gets you to that 5x target. The deal at $3.5 billion denies shareholders that entire journey. It's like selling a winning lottery ticket for the price of the paper it's printed on.
See, you're assuming the market is irrational for pricing it at 2.7 times earnings. I'm saying the market is rational because it sees the earnings disappearing. The analyst consensus, they expect earnings declines of 115% a year for the next 3 years. You cannot apply a 16 times multiple to negative earnings. 16 times 0 is 0. The deal is the ceiling because it is the only way to monetize these assets before the cash burn starts. If Hapag buys them out now, sure, the public investor gets a quick premium, maybe $25, $26 a share, but that is it. The 5x dream requires 10 years of perfect execution in a market defined by oversupply and chaos. The board knows this. That's why they're selling. They're taking the cash now instead of betting on a green read rating that might never even happen.
Or nah. Or they are being forced into a corner by the golden share and are taking the best deal they can get, even if it leaves a lot of money on the table. The very fact that the intrinsic value is $177 and the deal is a fraction of that proves my point. The asset is premium, but the situation is distressed.
Which makes the acquisition the ultimate take under. You're arguing the assets are gold, but the structure is lead.
I'm arguing that for the investor holding that stock on Friday the 13th, the acquisition is validation. It secures value. It locks in the gains from the lows of $11. It ensures the company, in whatever form it takes, survives. The price action tells you the market is breathing a sigh of relief.
And I'm concluding that while the price bump is real, the long-term, independent future of ZIM is dead. The deal protects the downside, I'll give you that. You won't go to zero, but it completely eliminates the massive potential upside. The public investor is being asked to hand over their lottery ticket just before the drawing. And worse, the Israeli domestic fleet is being left in this precarious economic position, totally severed from the global profits that kept it afloat.
So what does that leave us? The Hapag-Lloyd and FEME acquisition is the ultimate validation of ZIM's transformation. It secures shareholder value in a volatile market. It meets the golden share obligations. The stock price going up on February 13th signals the market knows this is a win.
And I say that while the price bump is real, the long-term independent future of ZIM is over. The deal protects the downside, but it eliminates the massive upside of that green fleet for public investors. We're watching the dismantling of a potential giant just to satisfy short-term fears.
$177 of potential value, sold for a safer tomorrow.
Or stolen for a quick exit.
The market will decide which it is when the ticker stops blinking.
If you like this video and want to watch more content like this, then subscribe to the channel. Thanks for watching. See ya.